5 fundamentals of halal investing. Number 1. What are your financial goals? Set clear goals. Some common goals may include investing for your retirement, children's education, to buy a house, or generate a return on idle savings. Quantify the amount or percentage return on your investments that you expect. This can then be used as a benchmark to assess the investment performance and determine how much risk you need to take on. Number 2. What's your time frame? Once you know your goals, work out how long you need to achieve them. Saving for a pension or a child's education fund may be long-term. This requires a very different approach to a young couple looking to buy a house in the near future. A longer-term goal may have higher risk investments, as time is on your side to recoup any losses, whereas a shorter-term goal may have lower risk in case you need the cash at short notice. Have a think about your time horizons, as they will determine your investment selection. Number 3. Understand your attitude to risk and level of Sharia compliance. Understanding and deciding how much risk you're willing to take is fundamental. You might have a long time frame and plenty of cash to fall back on, but if you don't think you would sleep at night if the markets became volatile, a high-risk approach probably isn't for you. Also, there are acceptable differences in opinion amongst the Islamic investment scholars. Whilst it's essential to have an open mind and seek to better understand these investments, if you still have doubts, it's simple. Don't invest in anything if you feel it's not halal. Number 4. How much can you afford to invest? Be realistic. Assess all your liabilities, like debts, monthly expenses, and other contributions to see how much spare cash you have to invest. Investing works best when you can take a long-term view, so if you may need cash in the short to medium term, make sure you have sufficient cash buffer that you can always dip into. A sensible cash buffer is between 3 to 6 months worth of cash. Number 5. Do you need income, growth, or both? Growth assets. These provide most of their returns in the form of capital growth. As an example, a property bought for £100,000 5 years ago is now worth £120,000. The £20,000 is the capital growth from the asset. Growth assets include equities and property investments. Income assets. These primarily provide returns in the form of income and include cash investments, saving accounts, sukuks, and some mutual funds. Income assets tend to provide more stable but lower returns. Growth plus income. A hybrid asset. Think of a rental property which provides rental income and also increases in value, or shares which provide a regular dividend and increase in share price. So in summary, the basics to consider when investing. Number 1. Your financial goals. Defining clear goals and, if possible, quantifying them. Number 2. Your time frame. Being clear on your investment time horizon. Number 3. Understand your attitude to risk, comfort around Sharia compliance. Number 4. How much can you afford to invest? Number 5. Do you need income, growth, or both?